Naked price action allows traders to focus on the only thing that really matters, the price. In this video, we have gathered some of the most fundamental price action signals and techniques that are incredibly useful. No matter what your trading strategy is, these methods will help you make better decisions and improve your trading performance. Today, we will show you how to identify these patterns on the chart, explain the psychology behind them, and demonstrate how to use them to make well-informed trading decisions. As always, please hit the like button to support us in making more videos more often, and subscribe if you are new. Number 1. The inside bar confirmation. An inside bar is a candlestick pattern with two candles. The first one is big, called the mother candle, and the second one is smaller, fitting completely inside the first. The psychology behind this pattern is that it reflects a moment of indecision in the market after a significant bullish or bearish move. If the price breaks above the highest point of the mother candle, it indicates a continuation of the trend. Conversely, breaking below the mother candle signals a pullback or temporary reversal. The same concept applies in the bearish scenario. But here's the question. How can we use this concept in our trades? Let me show you with an example. In this chart, we see a clear uptrend. The price has rejected this area, so we mark it in. When the price returns to this level, we can't consider this wick as a valid break of structure. This is because the wick shows that the price was quickly rejected back inside the range, meaning the buyers couldn't break through the level. If the price breaks and closes above this level, we can consider it a valid break of structure. However, this doesn't guarantee that the price will keep moving upward. If there's a fake out or liquidity sweep, the price may quickly return inside the range. This is where the inside bar candlestick pattern comes in. If an inside bar forms after breaking a market structure, it indicates temporary indecision in the market. If the price then breaks above this pattern, it means the sellers tried to push the price back inside the range, but failed. This confirms that the breakout is valid, and the price has a higher chance of continuing to move upward. A similar concept applies to ranging markets. In this case, we see a period of consolidation where the price seems trapped within a range. Two rejections from each side are enough to indicate a ranging market. Common strategies for trading in ranging markets include opening a position at a level on the third touch. You would place your stop loss above this level and target the opposite side. Alternatively, you can wait for a breakout to occur, where resistance becomes support, and then open a buy position with your stop loss set below this level. But how can we know if this breakout is valid and not a fake out? If a fake out occurs, the price will return inside range and make us lose the trade. So here, if an inside bar confirmation pattern forms, it shows that sellers tried to push the price back inside the range, but failed. This indicates that buyers are in control, making it more likely that the price will rise. You can even use this pattern directly to set up your trades. In a strong trending market, we often see very small pullbacks. If you wait for these pullbacks to enter the market, you might miss out on potential trades. This is where the inside bar trading setup comes in handy. When this pattern forms, you can place a buy stop a couple of pips above the mother candle and set your stop loss below it. This is one of the best ways to enter a position without having to wait for a pullback. Now let's move to the next signal. Number 2. Fakeouts. A fake out, or failed breakout, happens when the price breaks through a structure level but quickly returns to the range. For example, in an uptrend, if the market breaks through a resistance level and then returns to that area, the resistance becomes support, and we expect a rejection. However, if the market breaks right through and doesn't show any resistance, this is called a fake out. It indicating a significant shift in momentum and signaling a possible reversal, or a correction at least to the recent supply area. So how can we use this concept to trade in different market conditions? Let's start with a ranging market. In a consolidation or ranging market, we can identify two levels where the price is bouncing between. When the price rejects one side, it usually reverses to test the other side. However, when a fake out occurs and price returns inside the range, the chances of reaching the other side increase. Here's why. When the price breaks above a level, it triggers buy stops, and the stop losses are set below this area. When the price returns inside the range, it triggers those stop losses and causes the price to push lower with momentum. Now, what about trending markets? How can we combine this concept with market direction? In a clear downtrend, we are only interested in selling this pair. Trading alongside the dominant trend increases our success rate. However, if you enter at a bad price, a correction might cause you to lose the trade, only for the price to drop afterward without you. In this case, the price has formed a double top. If we see a fake out above this resistance area, it presents a perfect trading opportunity to open a short position, as this indicates the start of bearish momentum. This is how you can combine market direction with the fake out concept. Keep in mind, before placing any trade, you should always check the economic calendar. Trading right before the release of important news isn't wise, as the price can make sudden moves after the news is released, regardless of the technical situation. Number 3. Double top and double bottom entry. A double top or bottom is a popular M-shaped reversal pattern that price action traders commonly use. When a double top forms on the chart, it indicates that the price has failed to create a new higher high, possibly due to reasons like loss of momentum, a shift in market structure, or hitting a key level on a higher time frame. The most conservative approach to trading this pattern is to wait for the price to break the neckline to confirm the reversal. However, the downside is that if we enter after breaking the neckline, our stop loss may be too large. A common way to trade this pattern is to wait for the price to pull back to the neckline and look for candlestick rejections to enter trades. But we could miss the opportunity if we don't see a good candlestick formation. To enhance our trade entry, we can combine this pattern with the 61.8% Fibonacci retracement level. After breaking the neckline, we apply the Fibonacci retracement tool, available in the Indicators tab, from the start of the move to the end. We then place our sell limit order precisely at the 61.8% retracement level. But here's the question. When applying the retracement tool, how do you know when it marks the end of the move? The answer is that we can never be certain. Each time you place the retracement tool, if the market decides to move deeper, you should adjust the tool to reflect the latest move while waiting for a pullback. Remember, if we don't get a pullback and the price reaches our target, there's no point in looking for a trade anymore. The same concept applies in a bearish scenario. If the price rejects a level twice and completes the pattern by breaking below the neckline, we can use the Fibonacci retracement tool and place sell limit orders at the 61.8% retracement level. Our stop loss will be set below the swing low, and we will target the next level of market structure. But here's an important point. Trading every double top and bottom in the middle of nowhere isn't effective. The best approach is to mark a higher time frame key level that has rejected the price multiple times and then wait for double top or bottom rejections on a lower time frame. Or you can combine it with smart money concepts. For example, imagine if this demand area was an order block or a fair value gap in the higher time frames. After mitigating this area, forming a double bottom reversal pattern like this can be a perfect entry reason to go long here. In fact, combining smart money concepts with price action entries can produce some of the most accurate entries, as they are both powerful. Now let's move on to the next signal. Number 4. Shrinking candles. Shrinking candles refer to a situation where the candle's bodies become smaller and smaller as it approaches a supply or demand zone. Here on the chart, the price hit a key resistance level and reversed. Notice how the candle's bodies shrink as the price returns to this level. The psychology behind shrinking candles indicates a loss of momentum from buyers, resulting in a smaller distance pushed by the price. This serves as an early signal that buyers are losing control, and prices might reverse from this area. On the contrary, there is no apparent loss of momentum as the price approaches this support, and it breaks through. It is worth mentioning that this pattern works best when combined with another reversal pattern, such as a doji candle or a long wick rejection at the end. Number 5. Momentum candlestick pattern. The momentum candlestick pattern consists of two consecutive candles, with the body of the second candle larger than the first. The psychology behind this pattern suggests that strong momentum is entering the market, signaling a continuation in the same direction for the price. This pattern is most effective when the larger candle has no wick on top, indicating that buyers were pushing until the last moments of the candlestick period. Always consider it a trading opportunity when this pattern aligns with the overall market trend. Here on the chart, you can see these momentum candlestick patterns. Notice how the price rises after these patterns form. These signals alone may not be sufficient to make trading decisions, but combining these concepts will help you create well-informed trading strategies. Rising and falling wedge pattern. A wedge pattern indicates a period of consolidation where the price forms a condensing structure identifiable by two trend lines. This pattern reveals that the market lacks a clear direction, with buyers and sellers fighting for control. Breaking above or below the trend lines indicates which side has taken control. Breaking above a falling wedge during an uptrend suggests a continuation to the upside, while breaking below a rising wedge in a downtrend signals the price's intention to continue downwards. But when should we take the trade? Sometimes these breaks can be fake-outs, causing the price to return inside the range. Here's how to approach this trading opportunity. In a bullish scenario, we first need a break and close above the falling trend line. Additionally, a break above the previous market structure provides further confirmation. This confirms that the market has sufficient momentum to push upward. After this break, we'll look for entry signals to open a buy position. Entry signals could include various price action indicators, such as waiting for the price to return to the trendline area and observing for rejections or candlestick reversal patterns. To enhance our trade entry, we can also combine this pattern with the 61.8% Fibonacci retracement level. After breaking the trend line, we apply the Fibonacci retracement tool from the start of the move to the end. We then place our buy limit order precisely at the 61.8% retracement level. Combining high-quality signals. The best trading setups occur when multiple high-quality signals confirm each other, providing robust and reliable indications of market direction or potential price movements. For example, let's break down a high-quality trade setup. Here we have a moving downtrend as the market continuously forms lower lows and lower highs. So, we want to trade with the dominant trend. The recent impulsive move has created an imbalance. So, we mark the candle that created the imbalance as our key supply area. Shrinking candles appear as the price approaches the key level, indicating momentum loss. The market forms a double top pattern, suggesting a possible reversal. A long wick candlestick pattern occurs in the area of multiple confluences, showing reactions to this level. Now we wait for the price to break the neckline to the downside to confirm the pattern and enter a short position. This setup showcases numerous favorable factors for a short trade opportunity, making it a high-quality setup. Here's an important takeaway. Developing the skill to wait for high-quality trades and filter out low-quality ones is crucial for your success. Thank you for watching. If you found this video valuable, please hit the like button to show your support and subscribe if you're new. See you in the next episode.